Yes, sir.
During inflation, what happens is that to control inflation, the government, sorry, the RBI may increase bank rate. With that, what will happen is that now the funds would be available to commercial banks at a higher rate. Commercial banks have to pay higher rate to the RBI to rediscount the bills. With this, commercial banks also increase the rate at which they discount the bills for their customers. And because of that, this, the customers in the market, they get discouraged to get their bills discounted because now they would be getting lesser money for their bills. With this, they discount lesser bills. They wait for the due date of the bill instead of discounting them from banks. And because of that, they have lesser money with them for some time. And with that, they cannot purchase more. And this is how inflation can be controlled. Am I clear? Have you understood this, guys, or not? During inflation, the RBI may increase the bank rate, which increases the cost of funds for commercial banks on rediscounting of bills with the RBI. To keep their margin intact, commercial banks charge higher interest rate, that is discounting rate, to discount bills of their customers. With this, customers get discouraged to discount their bills with commercial banks, and this is how fresh supply of money or credit in the economy is restricted. This helps to curb inflation in the market. Right? Now, during deflation, guys, the reverse of this is done. When there is deflation, the RBI may decrease the bank rate. And this is how cheaper money is made available to the market so that demand could be increased. I hope you're understanding. When cheaper money is available, more people will go to get their bills discounted from commercial banks, and with more money, they will buy more, and this is how demand could be brought up, right? Note down this all fully. Note down this also, guys. Here, guys, we will have how, and this is how cheaper money is made available to the market.
Sir, can you explain it in short this bank rate? You said yesterday that it's the same as interest rate, right?
Right. So it is the interest rate
So,
which is charged by the Reserve Bank of India, that is central bank, to commercial banks. Commercial banks, whenever they are short of funds, they take money from Reserve Bank of India, and for that they have to pay interest at a certain rate. That rate is bank rate. This is how you should understand it, Tahir. Right?
yes, okay.
So when the
Yes, sir.
Reserve Bank of India increases this interest rate, cost of funds to commercial bank increases, and to keep their margins intact, what they do is they increase the rate what they charge to their customers, to the borrowers. This is how for borrowers the money becomes dearer, that is expensive than earlier. This discourages them to take money from the commercial bank, and this is how demand can be controlled in the economy and thereby inflation. Because when you do not have much money in your pocket, how will you spend more? And when you do not spend more, demand will come down, and this is how inflation would be controlled. Got me now, Tahir?
Yes, sir.
The second point, guys, here is a cash reserve ratio, or requirement, in short, CRR. Now, guys, what is CRR? I'm explaining you that first. All the banks operating in India, they have to deposit some amount in cash at a certain rate of their total deposits with the RBI. So suppose I have a bank, I own a bank, and total deposits in my bank of the public are rupees 100 crores. Let's say CRR is 4%. Then out of 100 crores, 4 crores I have to deposit in cash with the Reserve Bank of India. Now what does this mean? It means I can lend out only 96 crores. Out of total deposits of 100 crores, I can give loans to my other customers, the producers, entrepreneurs, only 96 crores. Is it clear to all or not? So this is how every bank has to keep cash at a certain rate of its total deposits with the Reserve Bank of India, and that rate is CRR, cash reserve ratio. I hope you have understood, guys. Right? Now, during inflation, the RBI may increase the rate of CRR. So suppose today CRR is 4%. Now, after some time, the RBI finds that there is inflation in the economy. Then the RBI may make it 5% or 6% or 7%. Now, what will happen? I have 100 crores deposits of public in my bank, in current account, in savings account, in fixed deposit account, in recurring deposit account. Out of that 100 crores, I already kept 4 crores with the RBI. Now I have to keep 3 more crores with the RBI if the rate of CRR is 7%. And with this, my lending capacity will further decrease. Earlier, I was able to lend out 96 crores. Now I'm able to lend only 93 crores. Is it clear or not? Since I can lend less, I can make lesser money available in the market. When lesser money is available in the market from my bank, people have to decrease their demand. They cannot purchase more. And this is how inflation is controlled. Am I clear? During deflation, the converse of this is done. If CRR is 4%, the RBI may decrease it to 2% so that lending capacity of commercial banks can be improved. And with that, banks will give more loan. When they give more loan, people will have more money, and this is how they will purchase new items. They will purchase new machines. I'm talking about producers, more raw materials, hire more laborers, right? If we talk about households, they will purchase more durable goods like electronic goods or automobile items like cars and bikes, more houses would be in demand in the market, and this is how deflation can be controlled. Am I clear? I hope you have got this, guys. One more thing for you to understand, guys, is that no bank lends out 100% of its lending capacity. So if CRR is 4% and in my bank 100 crores deposits are there, it means I can lend out 96 crores. But I will never lend out the entire 96 crores. I will lend to the maximum 40 or 50 crores. I do not want to take much risk. No banks do so. So I will lend out only 40, 50 crores. The remaining 56 crores, I will invest in share market or in real estate. That I can do. I am allowed to do this. And this is how the deposits money I will grow. So in share market, suppose in a year I'm earning 10%, but out of total deposits, what I have of public with me, I have to pay only interest at the rate of 3 4%. This is how the 6% margin will go in my pocket. Is it clear or not? So it is the rate at which every commercial bank has to keep deposits in form of cash with the RBI of its total deposits, total public deposits. Suppose a bank has total public deposits of rupees 100 crores and CRR is 4%, then the bank has to keep rupees 4 crores with the RBI to fulfill the requirement of CRR. This is how the maximum amount that the bank can lend is rupees 96 crores, is only rupees 96 crores. During inflation, the RBI may increase CRR, which reduces lending capacities of commercial banks. This allows borrowers to have lesser money from banks and thereby demand is brought down to some extent. On the contrary, To curb deflation, CRR may be increased. Sorry, may be decreased. Next point, guys, is statutory liquidity ratio or requirement. That is SLR. So, guys, apart from meeting the requirement of CRR, commercial banks have to meet one more requirement of the Reserve Bank of India, RBI, that is SLR. SLR is a rate at which every commercial bank has to keep certain amount of its deposits with itself only in form of cash or some approved government securities or in form of some precious stones. And this is how lending capacity of commercial banks is further controlled. Am I clear? Currently, I think SLR is 25%. So suppose I own a bank and where the total deposits of the public are rupees 100 crores. In that case, 25% of 100 crores, that is 25 crores, I have to keep with myself in my bank in form of either cash or some approved government securities or some precious stones. And that much I cannot lend out. Am I clear? So now my total lending capacity would be 25% after considering 25% of SLR and 4% of CRR. My total lending capacity would be 100 minus 29, that is 71 crores only. Clear? So I hope you have understood what is SLR. Now, during inflation, SLR can also be increased by the RBI, and with that, lending capacities of commercial banks is further reduced so that they could give lesser loan, so that people could have lesser money, so that they could buy less, so that inflation could be controlled. And during deflation, the reverse of this may be done by the RBI. That is, during deflation, the RBI may decrease the rate of SLR so that banks could give more loan, could supply more money in the economy. Clear or not, guys? SLR.
Sir, can you explain it SLR?
I just explained the
Yes, sir. The just the definition, like what is it?
SLR is the rate at which a commercial bank has to keep deposits, keep a portion of its total deposits with itself in form of either cash or approved government securities or precious stones. So suppose rate of SLR is 25% and total deposits in my bank are 100 crores, then 25% of 100 crores, that is 25 crores, I have to keep with myself in my bank only in form of cash or government securities by buying government securities or by buying some precious stones. It means this
So
25
from
crores, listen, it means this 25 crores is blocked with me. I cannot lend it out. Understood now?
so, so from that, banks cannot give money to the customers or
Right.
people who
They
come to.
cannot give any kind of loan out of that 25 crores. Right. Now, why there is requirement of CRR and SLR? Let me tell you that also, guys. It is for the sake of or for the protection of rights of or deposits of deposit holders. If I have total deposits in my bank of rupees 100 crores and the entire 100 crores I lend out, and the borrowers to whom I have lent out that 100 crores, they fail to repay my money. How will I repay money to deposit holders? Because that money is not mine. It is the money of deposit holders which I have lent out to borrowers. So I give it to a producer. Out of 100 crores, I give 25 crores to a producer. He starts his factory, but somehow his product fails in the market. He cannot earn any income out of by selling his products. In that case, he would not be able to repay my 25 crores. It means my 25 crores are gone. So how will I repay that 25 crores to my deposit holders? Those who have deposited their money in my bank in savings account or in current account or in fixed deposit account. For protection of this, we have these two requirements by the RBI. One is CRR and one is SLR. Got this? Got this, Tahir?
Yes, sir.
With themselves. CRR they keep with them with RBI. SLR they have to keep with themselves. And precious stones and metals. So a commercial bank to earn profits can also keep these as deposits in form of gold bars or silver bars where the prices of gold and silver may go up, and this is how banks may earn due to this appreciation. If you just keep cash with yourself, it will not grow itself. But if you keep that cash in form of government securities where government will pay you some interest, or in form of precious stones and metals, then you may have chances of appreciation. Am I clear? Next measure that may be taken by the RBI under its monetary policy, guys, please, and which is actually done by the RBI very frequently in reality is repo rate and reverse repo rate. Guys, here the term repo means repurchase option. So this is repurchase option. That is why we call it repo. Now, what this repo rate is, when commercial banks are short of funds, they may take loan from RBI, right? But for that, they also have to deposit some security with the RBI. Like when a producer or an individual wants to take loan from a commercial bank, you have to give some security, some collateral to the bank. Except educational and personal loan and all kinds of loans, including home loan or any other business loan or even vehicle loan, you have to keep some collateral with the bank, some security with the bank, so that later if you fail to repay bank's loan, the bank will realize or will recover its loan money from the security that you have kept with the bank. So when you take a take a vehicle loan, the vehicle itself is mortgaged with the bank. When you take a home loan, the home itself is mortgaged with the bank. When you take a loan to purchase a machinery, the entire machinery is kept by the bank as mortgage. Mortgage means simply giving original purchase bill or papers of that property with the bank. You can use the property yourself, but you have to keep the original documents of that, the legal documents of ownership of that property with the bank so that you could not resell it before repaying bank's loan. Am I clear? The same way commercial banks also have to give some security to the Reserve Bank of India while taking loan from it. The rate at which the Reserve Bank of India gives loan to the commercial banks is called repo rate. So what happens in repo rate is that means what happens when a commercial bank is short of funds and want to take loan from RBI is that the commercial bank goes to the RBI with some government securities. Government securities are nothing but government bonds, which commercial banks have already purchased by investing in government bonds. So government bond is an investment instrument. Like fixed deposit is an investment instrument, like insurance policy is an investment instrument, the same way government bond is also an investment instrument. So you purchase government bond from the government, and on that bond, government gives keeps paying you interest every year. This is how you are giving loan to the government. Commercial banks invest a lot, huge sum of money in government bonds. Why? Because government bonds are the safest instruments because they will never fail. Whether there is government of Narendra Modi or some other person, it's ultimately the Indian government. So if you have given any loan to the Indian government for sure will pay you the your money back. And until it pays, it will pay you interest at a certain rate. Am I clear or not? So commercial banks invest a lot in government banks. Why? Because that is the safest instrument of investment. Now, with those purchased bonds or securities, the commercial bank has to go to the RBI to take a loan. So by keeping those securities with the RBI, The bank gets loan from the RBI at a certain interest rate, and that rate is called repo rate. Now, what is repurchase option here is that whenever the bank, the commercial bank has excess or surplus money, it may go to the RBI and take its securities back and pay back money to the RBI. This process actually is called, instead of considering it as repaying RBI's money, it is considered as now RBI taking loan from the commercial bank. Are you understanding this, guys, or not? So suppose I own a bank and my bank is short of funds and I have some government securities with me. I with those government securities I go to the government to the Reserve Bank of India, keep those securities with the Reserve Bank of India and take a loan. Let's say loan rate is 6%. That 6% is repo rate. After some days I have some surplus money. So I go to the RBI, I repay the money to RBI and take back my securities. That is why we call it repurchase option. Means I can purchase my securities back from the RBI. When I repay the money to RBI, that actually is considered as giving loan to the RBI. And that time now commercial bank charges certain rate to the RBI and that rate is called reverse repo rate. Have you understood or not? So between Reserve Bank and commercial banks, the money keeps flowing from one to another in form of loan. When RBI charges interest on loan given by to the commercial bank, that rate is called repo rate. When commercial bank charges interest to the RBI on a loan given by it to the RBI, that rate is called reverse repo rate. Reverse repo rate is always lesser than repo rate. It means the interest rate what RBI charges to commercial bank is higher than the rate what commercial banks charge to the RBI. Am I clear? Have you understood this, guys? Mansha, Mishika, and Tahir.
Yes, sir.
Yes, sir.
Okay, during inflation, again the repo rate is increased by the RBI. RBI has done it in last 3 years. It has increased the repo rate by more than 10 times. It has increased in last 3 years repo rate more than 10 times to control inflation. And they are going to do this again soon. When repo rate has increased, the cost of funds to the commercial bank also increases, and with that, commercial banks charge more interest rate to their borrowers. Because of this, for borrowers, now the money becomes costlier than earlier. With costlier money, no one would like to spend unnecessarily, and this is how demand is controlled. Am I clear or not? And during deflation, the repo rate is decreased. So I hope, guys, you all have understood this. Now I'm writing it. So guys, the last point under quantitative measures of the RBI is open market operations. Now guys, we today itself we have discussed that to meet SLR requirement, commercial banks have to keep certain portion of their deposits with themselves in form of cash or government approved securities or precious stones and metals. Out of these three things, the most common choice of banks is government approved securities because the risk is very limited here. In fact, no risk at all. The safest instrument is government approved securities. So, not only to meet their SLR requirement, but also otherwise also commercial banks invest too much in their government securities. Have you understood this or not? So suppose in my bank there is total deposits of 100 crores, SLR is 25%, that is 25 crores, and CRR is 4%, that is 4 crores. It means the total amount that I can lend out is 100 minus 29, that is 71 crores. But I would not lend out entire 71 crores, rather I will lend out only 40, 50 crores. The remaining 21 crores I will invest in government approved securities, in some good scripts in share market and in real estate. So out of 21 crores, around 10 crores I will invest in approved government securities as they have no risk at all, and they have certain return in form of interest payable by the government to those who purchase government bonds. Am I clear? Now, when there is inflation, okay, let me also tell you what is government securities. Government securities are government bonds which are made by governments, either central government or state government, and by making those bonds, governments take loan. Government do not go to public directly, but governments take loan or raise loan from the public through the Reserve Bank of India. So whenever a government, let's say our central government, that is Union Government of Delhi, requiring some funds, some loan, it will go to the RBI. It will make some bonds with government stamp, that is stamp of Indian government on it, and will give it to the RBI. And this is how the RBI will give fresh currency to the government. But the next thing what RBI may do during inflation is that those government bonds would be auctioned by the RBI in open market operations. So during inflation, what RBI may do is that RBI may auction government bonds which it has with itself. Why it has the government bonds with it? Because through those government bonds, the RBI has already given loan to the central government. Those bonds are auctioned in the market, in the open market, where all the money market participants like commercial banks, mutual fund companies, insurance companies, they all participate because they all want to invest in government bonds. So by selling government bonds in open market operations or through auctions, the excess supply of money in the economy is sucked by the RBI. Because when a commercial bank will purchase bond from the RBI in auction, ultimately money will flow from commercial banks to the RBI. And with this, commercial banks now will have lesser money to lend to their borrowers. And with that, the market will have lesser supply of money, and this is how demand would be controlled. The excess demand would be controlled. Am I clear? On the other hand, when there is deflation, the RBI again may conduct auctions to purchase government bonds. During deflation, it sells government bonds. During deflation, it purchases government bonds, and this is how its it supplies fresh money in the economy. Understood, guys, or not? This overall is called open market operations. Now, guys, tell me if you have understood this fully or not, so that I could start writing it. Mancha,
Yes,
Mishika,
sir.
Tahir, and those who are here. Understood? Pakka. Tahir, are you saying something?
No, sir.
Okay. We are just winding up. 2 minutes. This is the last point for today. Yeah, you can. Yeah. This was the last point of quantitative measures taken by the RBI to control inflation or deflation. That is to control excess demand or deficient demand. So that's it, guys. We will have it in our next class.